Hello, this is Brian Beaulieu. It is July 14th, 2023, and welcome to FedWatch. 4 points I want to cover this week. First is that the June CPI data came out, as you probably read, and the headline CPI is down to 3.0%, which is easily within striking range of the Fed's stated goal of 2 to 2.0, but they want that in terms of core inflation. They're not likely going to easily achieve that. The core CPI was at 4.8%, so well above the 3.0. And even the PCE price deflator core that they like to use last month was at 4.6%. So there's still a struggle to go there, and it's because of wages, as we've talked about before. The disinflation trend that's been going on right now is it's impressive, folks. Inflation is coming down fast. We haven't seen anything like this slope since 1951 through 53. Other than that, you have to go back into the 1920s, particularly 21, 23, and then one other time in the mid-20s to see anything like this. And it's coming down so fast because it went up so fast. The ride was upward steeper than normal, and slightly stronger than the 72, 74 trend, if you remember that, or if you like economic history, that was the Arab oil embargo that drove those prices so high, and was followed by a massive recession. And other than that, you have to, again, go back into the 1920s to find anything like this. So, you know how Alan and I have talked a lot about, and Prosperity in the Age of Decline was about how there was going to be some mirror images to the 20s. Lo and behold, we're experiencing some of those. Notice that those were in the early to mid 20s, not the end of the 20s. We're not at that 30s breakdown point yet. That's important to keep in mind. It's also interesting that we're in the 50s because that's a theoretically interesting period for a comp, and that'll help us come up with I think a solid 15-year forecast for the consumer price index at our July 27th or for our July 27th webinar. Second point I want to bring up is that while we appreciate this disinflation, you should all keep in mind that the worst of the punch from these higher interest rates, the biggest bite, is yet to come. I mean, we're just in the early days of this rising trend. I know it feels like forever, but it's going to be late summer, fourth quarter, when these interest rates really begin to bite into the economy. And we can tell it's going to come down, and this is the third item. And the Fed, therefore, should just relax. I mean, the Atlanta Federal Reserve president is on record saying, stop, we should just wait. There's a time lag here. Let's just see what the effectiveness is going to be before we push these rates up even higher. I mean, if you're a business person or you just care about what ordinary people are going to pay for interest rates, he's a real good guy at the moment. The reason we know it's coming down far further and fast is that the producer price index went into negative territory, and the intermediate materials price index dropped down to minus 9.4% compared to 1 year ago. That's the weakest 112 rate of change that we've seen in over 13 years. I mean, this is a big deal. So the CPI is going to continue to come down, but not necessarily the core CPI because of the labor portion. Which brings me to the fourth point, and this is really an idea more than anything. We would be so much better off if the Fed would just pivot some and get off this core CPI. I mean, the core concept came about because food and energy prices were initially keeping the inflation rate too high under Jimmy Carter, so they came up with core inflation so that President Carter could show a lower rate of inflation. That's the genesis of core. They're getting inflation down to the 2.5% if they just look at overall inflation. And their mandate is to provide price stability for Americans and maximum employment. Well, if they just get off the core and look at regular CPI, then they can achieve both without causing a steeper recession or intentionally causing unemployment to go up significantly. So will they do that? Probably not, although it's encouraging again to hear the Atlanta Fed president talk, and to hear the biggest hawk is going to be leaving the room this summer. So that's encouraging also. Be careful. Take the win on inflation coming down. Back off on your wage inflation internally to the extent that you can, because you don't need to be pumping up those prices, those wages, as much as you had before. We'll probably find out at the end of July 26th to be exact, that they have raised interest rates another 25 bips. And that should be it. It really should be it, unless they're just totally insane. So that's it for now. Thanks for joining me for this edition of Fed Watch. We're seeing good improvement in disinflation. They have a way out of this. Wages aren't going to break downward. They're just not going to. Thank you for watching. We'll see you next week.